A company's payout policy is the specific mechanism it uses for opening the vault and distributing physical cash directly to its shareholders. When we clear away the noise, there are exactly two ways a corporation can execute this transfer of wealth: paying a regular cash dividend or repurchasing its own shares. To understand capital allocation, we have to immediately dismiss accounting illusions like stock dividends and stock splits. These actions do not distribute cash. They simply require carving the exact same pie into smaller slivers. The total circumference of the equity remains identical, and zero actual wealth is created. Reverse stock splits operate on the exact same hollow logic, typically deployed only to artificially inflate a collapsing share price to avoid being delisted. They do not alter fundamental shareholder wealth. The core objective of any genuine payout policy is the physical movement of cash. But moving that cash from the corporate treasury to a shareholder's pocket introduces a theoretical paradox. Does this transfer actually create any new value for the investor? To answer that, financial theory starts with a baseline formulated by economists Modigliani and Miller. They argued that in a perfectly frictionless, perfectly efficient market, a company's dividend policy is mathematically irrelevant. When a company pays cash, corporate equity shrinks by that exact amount. The shareholder gains cash, but equity drops. Net wealth is unchanged. Alternatively, investors can manufacture a homemade dividend. They simply sell a fraction of their stock to generate the exact same cash flow. If markets were truly perfect, managers wouldn't need to waste time debating payouts. But markets are saturated with taxes, information gaps, and conflicting interests. In the real world, these frictions turn payout decisions into critical levers for extracting and preserving value. The first friction that breaks the perfect market theory is human preference. The bird-in-hand theory recognizes that investors steeply discount the future. Many will gladly trade the promise of an uncertain capital gain tomorrow for a guaranteed cash dividend today. The second and far heavier friction is the tax code. Depending on where an investor lives, capital gains and cash dividends are often taxed at entirely different rates. Corporate boards optimize payouts for local tax regimes. Under imputation, corporate tax paid attaches a tax credit to the dividend, offsetting shareholder taxes. Alternatively, a split rate system taxes corporate profits at entirely different rates. Retained money faces one rate, dividends pass through a lower one. A payout policy cannot exist in a vacuum. Management must reverse engineer their distribution methods to survive the specific tax gauntlet of their home jurisdiction and maximize the cash that actually reaches the investor. Beyond taxes, we hit the third major friction: information asymmetry. Corporate insiders always know more about the true health of the firm than external analysts do, making dividend declarations one of the few hard, verifiable signals sent to the market. When management initiates or increases a regular cash dividend, they are making a binding commitment. This mathematically proves their supreme confidence in the company's ability to generate sustainable, long-term cash flow. Conversely, cutting or omitting a dividend broadcasts a catastrophic signal. It is a public admission of distress, and the market violently punishes the stock. This dynamic directly addresses our fourth friction: agency conflicts. Managers inherently prefer to hoard excess cash for safety and expansion, while shareholders want those excess returns distributed. By committing to a rigid, regular cash dividend, a company aggressively drains excess cash from its balance sheet. This physical removal of capital strips managers of the liquidity they might otherwise squander on unprofitable, empire-building pet projects. Regular cash dividends act as strict behavioral leashes placed on corporate executives. They enforce capital discipline through the constant threat of market repricing, turning a quarterly payout into a governance mechanism. Because the market violently punishes any reduction in yield, boards cannot simply set a constant payout ratio. Applying a fixed percentage to highly volatile annual earnings would force the dividend to swing wildly year over year. To solve this, companies utilize a stable dividend policy. The goal is to align the long-term growth rate of the dividend strictly with the long-term growth rate of earnings, intentionally filtering out short-term economic noise. The engine is the gradual adjustment process, suppressed by the adjustment factor. This acts as a shock absorber. In boom years, it restricts the dividend from chasing unsustainable peaks. And when earnings plummet, the smooth dividend curve holds steady, bridging the chasm without breaking. A perfectly stable dividend is rarely a natural occurrence. It is a highly engineered financial product, mathematically calibrated to project an image of corporate invulnerability, regardless of the chaotic reality beneath the surface. When management wants to return capital without trapping themselves in the rigid expectations of a permanent dividend, they pivot to share repurchases, entering the open market to buy back their own stock. Structurally, all else being equal, a $10 million buyback has the exact same impact on total shareholder wealth as a $10 million cash dividend. The total cash leaving the firm is identical, but the financial optics are entirely different. Repurchasing shares with exact cash eliminates a portion of the outstanding stock. Because the company's total earnings are now divided by a smaller number of shares, the earnings per share mathematically increases, even if the actual business hasn't grown at all. There is a vital caveat if the company borrows money to fund the buyback. In a debt-funded repurchase, EPS will only increase if the company's earnings yield is higher than its after-tax borrowing rate. If the debt is too expensive, the buyback will actually destroy per-share earnings. When checking book value per share, repurchasing shares at a price greater than the current book value actively depletes the remaining value for investors. Conversely, if management executes a buyback at a discount, it instantly inflates the book value for surviving shares. Buybacks are heavily marketed as returning value to shareholders, but mechanically, they are uniquely powerful levers for management to legally manipulate the per-share financial optics that often drive executive compensation packages and market multiples. Corporate boards face a continuous optimization puzzle. They must balance the rigid, high-trust signaling of a stable cash dividend against the highly flexible, metric-boosting power of open market share repurchases. Most modern firms refuse to choose just one. Instead, they maintain a conservative, highly defensible regular dividend and deploy share repurchases selectively to flush out extraordinary cash during boom years without raising permanent expectations. An analyst's primary responsibility is verifying whether a payout policy is sustainable. This requires determining if a dividend is genuinely supported by operating cash flow, rather than being propped up by financial engineering. The early warning signs of an impending cataclysmic dividend cut are highly specific. Analysts watch for a deteriorating dividend coverage ratio, a suspiciously high dividend yield compared to peers, and the ultimate red flag, a company quietly taking on new debt just to fund its existing payout. Perfect market theories assume payouts don't matter, but in reality, taxes, signaling, and management incentives heavily distort how capital flows. Understanding payout policy means looking past the surface optics, tracking the physical cash, and separating genuine wealth distribution from a fragile financial facade.